Hey, welcome to the podcast, everybody. Thanks for joining me. The stock market is closed on this wild week. As you can see from the screen, not a lot of green. There was a little bit of a bright spot. The utilities were stronger today, and they've been a nice hedge for the most part. Last year, of course, they were pretty strong. The first part of this year, pretty weak overall, because of the fact that money was rotating out of the quote-unquote safer things and going into some of the riskier assets. Now that seems to be coming back out of the market, back into utilities. Only green thing on the screen today, you can see the Dow Jones just closed, finishing down around 170 points. Transports were down 1%. S&P 500 down 1.62%. And really, as we go through them here, you'll see it's pretty red all the way across. Financials got hit pretty hard. Technology got hit pretty hard. The Russell 2000 down 1.8%. Semiconductors over 2%. The oil service stocks down 3.8% as oil completely fell apart. And we all know as oil, has been falling here, and it's been falling primarily because of the fact that, look, we know that we have a slowing economy. And for those that thought over the last few months the economy was super strong and that last summer's slowdown was just an anomaly, this is the norm. Now, we don't know if it's in full recession mode yet, but it's certainly slow. At best, it's slow. And so what's happening now is you're seeing oil starting to come back down, which had been holding up very well. But here we are, $103 earlier today, and then it falls down to just about 98.5, down about $4. So big drop off for oil. Now, it all started this morning, of course, when we had the non-farm payrolls. The number was supposed to be 160,000, came in at 115,000, was revised up last month. These numbers are just, they're all over the place with these huge revisions. Bottom line is that we're not adding enough jobs. And, you can see the picture out here that I have on the screen, and this is one I've showed in the podcast before, either on the podcast or through an article. But basically, I have the S&P in the blue, and then you have the non-farm payrolls in the red, and the ADP, which is a private company, in the green. And very, very correlated, of course, as we started having less jobs being added. Of course, stock market was coinciding. And by the way, you notice how this was an early indicator in 2007. A lot of you were listening to me, either podcast, radio, watching on TV. And at that time, we were talking about the fact that, hey, the economy's slowing. One of the things I was watching was the fact that this was rolling over, yet the stock market in blue continued to make new highs for almost a whole year. Also in there, we started to see a lot of deterioration in the internals of the market. And we'll get to that in a minute. But right now, you see that so far, this has been kind of confirming this stock market going up. So it's been going up, but we are starting to see some signs potentially that it's cracking. You can see the stock market is still close to highs, even though these numbers are lethargic at best. With 100, 200,000 jobs coming in, we really need something like a consistent 250 to 300 even to get this economy back on track. And we're just simply not seeing that, and the stock market is now reflecting that. Don't forget also the participation rate. There are so many people that are just giving up looking, and this is something I talk about every single month with these numbers. But what are you going to hear tomorrow? You're going to hear on the news tomorrow morning on the morning shows, you're going to hear, hey, the economy added 115,000 jobs, and it's been for the last 2 or 3 years, we've added so many millions of jobs. But again, you have to, and by the way, you'll see the unemployment rate will say, hey, it's dropped again. It's at 8.1%. But the news isn't going to talk about the participation rate. They aren't going to talk about those disgruntled workers that really want to be working full time. They're simply going to focus on the fact that the unemployment rate is dropping. And if the participation rate continues to drop as fast as it is, and with the people leaving the workforce as fast as they are, the unemployment rate is going to continue to fall. So it's a really misleading number, and unfortunately, I would say most people believe that number, but a lot of those people don't have jobs, so I don't think they can believe that number. But that's what you're going to hear about all weekend. So bottom line is the economy is showing what it really is, which is very mediocre at best. And it's not to say the stock market can't keep going up in a mediocre economy. It did that for most of 2003 through 2007. It really did that. So it's not to say it can't do that, but it can't be decelerating the way it is, and on top of that, having the emerging markets decelerate at the same time. That is the main concern for equities. And equities aren't terribly expensive. Some are, some aren't, but it doesn't matter. I mean, if you say, well, it has a 15 PE on it, XYZ stock, well, that may be great, but if it drops 10%, it's still going to have a 13.5 PE, right? I mean, it was cheap before. It's a little cheaper now, but a 10% drop on the stock isn't good. So stocks are okay. It just depends on where you are right now. And like I said, right now what's happening is you're seeing a big move out of some of these areas. I'm going to go through some of them in just a minute. Okay, let's start out with the S&P. So we have the S&P here, and I had discussed the fact over the last, probably 2 or 3 podcasts that one of the concerns was potentially this head and shoulders, where we had the shoulder, we had the head, and then potentially the other shoulder. And, as long as we didn't break below here, everything was good. And we kind of broke up to the upside, and it looked like maybe clear sailing. And now what's happening is in the last, 2-3 days, all this stuff is back in play again, because now what people are looking at is they're saying, double top there, and down we go. One thing that's concerning for technicians, and it's not, it's a short-term indicator, but it is something to watch. Right in here, you've got the 20 crossing the 50, and that's something that we hadn't seen going all the way back to last year. So you're seeing the 20 cross the 50-day moving average, and so again, that's just one more thing for technicians that trade. There's some people that trade on very specific things, and they have these rules. I only do X if Y is present, or I only do Y if Z is present. And for those that say I only buy stocks when these moving averages are above one another or headed in the right direction, this is something that obviously is causing those folks to sell. So you have the fundamental people right now questioning the economy, and you have the technical people saying, it looked like we're in the clear, and we've had essentially what is a fake out breakout. And I've used that term before, and a lot of stocks had that this week. A lot of stocks were doing very well and looked like they were resuming up, and then poof, broke out, only to be the fake out, right? Apple being the perfect example. Apple had come down to a nice support area here where I really wanted to buy it, but this was the day they reported earnings, so I was very hesitant to do so. And lo and behold, they blow away earnings, the stock pops big time, and the next day about 10%, and it's given it almost all back now in just about 5 or 6 trading days. And that's very concerning, because all those people who said, boy, I wish I would have bought it, they didn't buy it afterwards. Me being one of them. I didn't go in that day after they reported earnings and say, well, I missed it, I'm going to make up for it by buying it now. Because look, had you done that, you would have bought it here, probably somewhere around the 610 area, 615, 620 even. And look where it is now, 565. And you say, well, yeah, but this is a multi-$100 stock. Well, 62 to 56 is still a big drop. And when we zoom out a little bit on Apple, we do see that, hey, this thing could have further to fall. I mean, if it breaks through this support here, which if it bounces off of that great potential double bottom here, but if it doesn't, you start talking about the mid 400s, high 400s. So, there's several little steps, so to speak, that this could fall to in support levels. But bottom line is this is falling on heavier volume as well today compared to yesterday. So, it's something to watch. And again, the main issue here is that you have Apple, which was a big leadership stock, falling off, right? You have Starbucks, a big leadership stock, falling off. Chipotle, CMG, right? It came down and it bounced, and now it's failed at the 20-day moving average, and it's heading down. So you're having the leadership go away. One thing that's holding up, though, is that we do have consumer staples. The REITs are holding up okay, so there's still places to hide, and I think that's extremely important to realize, because what happens in a bear market is there's really nowhere to hide. And right now what happened was you could hide in leadership, then the leadership went away, and you could hide in tech, and then the tech went away, and then financials obviously aren't participating anymore, but you still have staples and REITs and and healthcare and things like that. Those, how long can those do okay? Well, if the economy just meanders along here, then certainly I think those, we'll call them recession stocks, will do quite well. And that's really, I mean, when you look at the big picture of what I own, that is a big chunk of what I own. And I don't own a lot of stocks percentage-wise anyways right now, but the ones I do own are things in the healthcare, the high dividend, things that held up very well today. And I certainly have some stocks for trading. We talked about DAR last time, Darling International. I got stopped out today. So I do have some more volatile kind of trading stocks, but in the big picture of what I'm doing for big part of the money that I look over, it's still this little bit more on the conservative side of things, we'll call it. Coca-Cola, sold that today. I was watching Coke, and of course had great earnings. The stock ramped up and pulled back, bounced off it, ran up to this other line here, which obviously that line wasn't there before I drew it. But if we go back and look in time here, you'll see why this line was drawn in the first place. Let me get rid of some of these so you're not distracted. But here's the thing. It went up, broke through this old top, came right back to it at 71. That was a good entry point if you weren't in the stock. Took off. I've been holding it for quite a while, and you can see here that we're right at the top of this. So it could pull back, and then it may be a good entry point. So it's not a overly cheap stock at this point. It's not overly expensive. It's obviously a consumer staple, only down 0.5% today, so it went down about a third of what the overall stock market did. But still, when you look at a picture like this and it's gone vertical, you take your profits out of it, and that's exactly what I did today. So let's run through these. We take a look at the XLF. XLF, of course, financials were doing very well this year, at practically new highs here, and just as late as early April, late March. And now what you're seeing is they're starting to fall off as well. And so XLF was obviously participating, doing very well. Now you're starting to see that fail. And remember, I've always said that the tech, semiconductors, financials have to participate in rallies for it to be a healthy market. And they were participating for much of this year. And now they're starting to fall at a faster clip than the overall market. Financials didn't totally underperform today. I mean, the S&P was down 1.5%. This sector was down 1.7%. So it's not as if they're falling at a much faster rate, but it is something that you want them to be holding up on a relative basis, and they still aren't. You look at energy, of course, oil down big, and of course these energy stocks down big as well. XLE, which had been getting beaten up, had a nice rally for the last few days, and then ran into the 50-day moving average, and poof, all those gains in the last 3 or 4 days gone. And if you notice down here, heavier volume as well. So you can see, I'll zoom in a little bit. They weren't participating for the last couple of months. Had a nice run. XLE went from a low of 67 up to a high of about 73 in just about 7 trading days. And in 3 trading days, it gave it all back, down 2.32%. So energy underperformed the NASDAQ. It underperformed the semiconductors. And really, that was a big deal in the market today. Now, again, for those that are a little on the bullish side, you're saying, great, everybody was complaining about energy prices going up. Now they're coming back down. Isn't that a good thing? Well, it depends on the reasoning. But yes, oil is coming down, but that's probably because of demand destruction because the economy's bad. If the economy's bad, the stock market does poorly. So it just depends. But yes, in the big scheme of things, is it good that energy is coming down? Sure. I drive a car. I like when energy comes down. Okay, technology. We're looking at technology. Obviously, was heading up quite nicely for most of the year, and then ran into a little trouble. Here is the 20-day moving average. Broke through that to the downside. Snap back. Looked like, again, we were in the clear the last few days, and now it's headed back down, and the 20 is crossing the 50, just like on the S&P 500. Remember, a big chunk of this is going to be Apple, but it's not just Apple now. Now you're having a lot of companies fall as well. And look, some of these earnings have been awesome. In fact, if you look at, I own a company right now in kind of a trading called CF Industries. This is a company that in the ag space. Very good company, very cheap company, tons of cash flow, fundamentally just unbelievable. They blow away earnings last night, yet the stock is down 7% today. This is when people are saying we need to liquidate. That's what this looks like to me, because they're liquidating everything across the board. But CF's okay right now, still moving sideways. This is when I talk about a fake out breakout. This is it. Boom, 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 breakout. Everything's coast is clear. Not so fast, my friend. Here we go, back down, heavier volume today. But I'm still holding on to that one, and it's not because I'm going to hang on to it to the death, because it's a great fundamental story. I'm watching it because of the fact that they reported excellent earnings, and we'll see on Monday if they come out and you see all these brokerage firms say, hey, we're going to defend CF Industries and we're going to upgrade them even further, and you oftentimes see that. And it didn't finish on the lows of the day. Stock market was very close to it. CF actually, low was about 181. It finished almost at 184. So, but that's a small position, but that's an example of what I call a fake out breakout here, where you do see that, where it runs up, looks like the coast is clear, and then comes back in. Here is the picture of utilities. Utilities obviously had been running up, and even though finished up on the day, gave up some of their gains, but still, on a day like today, to see something green is quite impressive for a whole sector like this. I've owned utilities for a long time, still continue to like them. You're getting almost a 4% yield as a basket, and they're doing very well, and people turn to them. The ones that still want to own stocks go down the beta scale, the risk scale, the volatility scale, and they've turned to utilities. So here's utilities, and again, the market's been struggling lately. Utilities has actually been getting better and not worse. I'm pointing out here the junior miners. This is an ETF that invests in gold mining companies, but it's the small ones. This has been getting obliterated, and I don't have a position in this, but I'm going to be writing an article in the next couple of days on this, because we're seeing some unbelievable extremes in junior gold mining stocks compared to gold. And it's really, there's in the last several years, how cheap these are on a relative basis is at one of the highest levels. It's only happened about maybe 4 or 5 other times that I can see going back several years that stocks of the gold mining companies are this cheap relative to gold. And again, that's not to say that we run out and buy these today, because the chart looks awful here. I mean, you got the 200-day moving average going south, all these moving averages going straight down. But for those of you that can pull off the pairs trades, or do something with, potentially some writing some puts on this, these pairs trades could work where you're basically shorting gold going long the miners. But I'm going to come out with an article showing some of these extremes in the next couple of days. Maybe over the weekend I'll do that. But it's quite impressive. Unless you own it, then it's not impressive. But if you're standing there watching this happen, it's quite impressive what's been going on in this area. So I've got the S&P 500 up here, but I've changed to the spiders. So the numbers are a little different. Just add a 0 on the end, I guess, if you want to see the S&P. But here's the spiders. Notice the volume picking up in the last couple days as we're going down the volume. The strongest volume we've had going back 10 or 12 days. Much stronger than the ups. So that's a concern for if you're bullish. That should be a concern of yours. But I've drawn some Fibonacci retracement lines. And if you notice here, we bounced off the 23.6 line back in early April. And the next logical place for this would be somewhere in the 38.2, which would be around 1320 on the S&P. Maybe at the high side would be 1330. So 1320 to 1330, you're looking at another 40 to 50 points on the S&P. Could it do that? Yeah, that's only 4%. And we could see a 4% drop easily in this market, given that this economic data is getting worse and the selling's starting to intensify. We got this going on right here. So where would that be? That would be somewhere around here. And, maybe it does this little pattern and then eventually bounces off it. Again, if you're somebody that's bullish, you're saying, hey, this is just the market breathing. This is just the market absorbing some of these gains it had from the low of around Thanksgiving to the high, which was, early April. This is just the market doing what it's supposed to do. Could be, but we are starting to see some deterioration in the market in the sense that we're starting to see the economy get weaker. And remember, you still have folks out there like ECRI claiming that we are in a recession and we will see it present in 2012. And then secondly, you're starting to see deterioration in things like financials, energy, and now tech, and you've got the leadership negative. What we don't have yet is we don't have overall distribution, we'll call it. We don't have, and it may be just now starting, but we don't have, the sellers haven't been real active in this market really going back until last summer. And so what's happened is every time we've had a pullback, it's because buyers or the bulls are saying, you know what, we're going to take a break and maybe see if we can get some of these things cheaper. In other words, they've been buying the dips. So now what we're seeing is potentially you're seeing a selling the rally, and it just started 3 or 4 days ago where we were rallying, went up to this, 1420 area or so on the S&P, and it was met with selling, and it was met with heavier selling. And how do I know that? Well, the volume has gone up. So the selling has come in, and does lower prices attract new buyers at some level? And again, it depends on the economy, and it depends on basically the mood of investors. And they've had an appetite for stocks. And one of those reasons is because of the fact that where else do you go? I wrote an article recently about stocks being a default place, right? When you start looking at interest rates in the big picture and go, well, bonds, as far as treasury bonds are concerned, are wildly expensive. Yes, you have a natural buyer there in the Fed, but they're wildly expensive. You have money markets and CDs paying nothing. And so what's left? Well, stocks. Stocks have been left because they pay dividends and they've been pretty stable. But you can toss all that out the window when there's fear. When fear picks up, guess what does well? Treasuries and cash. We saw it today. But I was given the rationale why stocks have been going up, and they've been a default place for asset allocation. Because remember, there are folks out there, and it's not you and it's not me. We don't have to have our money invested all the time. We can sit in cash. But there's folks out there who that is their mandate. They have to be invested at all times, i.e. mutual fund managers, i.e. pension funds. So what they do is they allocate it based on the place to be. And the place to be is something that generates income. And that income has been coming in the form of dividends, not interest. So for those that need some type of cash flow, they've been flocking to dividend-paying stocks, good old American stocks, and it's been working. But in the last couple days, it hasn't worked, and so now you're starting to see the selling intensify a little bit. So definitely a lot of red warning flags, but we're still up until now. You haven't seen the intensity in the selling. If that continues, then we go in a more defensive mode, where we simply start selling the rallies as opposed to buying dips. And it's too early to tell right now, but certainly your beta should be pretty low, meaning what is your correlation to the overall stock market? And for the big portfolios, I would say that it should be on the low side. And again, look, things are going to get stopped out. This is a stock I've used for trading. We talked about Darling International earlier. I mentioned it in a podcast. It was setting up for a nice bounce. It had broken through here, come down, bounced off this, spent a few days hanging out in this area, turned the corner, and guess what? Failed. And it failed, and it broke through, had a discipline, stopped it out, and you move on. Great fundamental story, by the way. So this is one you leave on your radar screen, and when it technically looks good, then it can be bought again. But this is an example. And these types of stocks, these smaller companies maybe you haven't heard of, these aren't big parts of my portfolio. These are more for a trading strategy where we do try to get in and out, the Amazons of the world and Darling International and stuff like that, and CF Industries. But great fundamental stories. But this chart here has broken down because the bounce that I was anticipating didn't happen. And if it doesn't happen, we move on. And that's what I've done with this one. So, anyways, I hope that helps going through some of those ETFs and charts. But there's not a bunch that really looks great right now. So, bottom line is just be patient, because if this is a bull market that's going to continue, it will give us time, and it may even just be moving sideways for a while before it does that. So, but the economic data certainly has not supported a runaway bull market, has it? All right, guys, don't forget, KarlEggers.com is my website. EggersCapital.com is the corporate website where there's a money management part of what I do, and that is the website for that, EggersCapital.com. Follow me throughout the day on twitter.com/Karl Eggerss. And then for those that like Google+, it's plus Karl Eggerss. All right, take care and have a great weekend.